The Horde team has done something that I think is not the very smartest move. They've increased the balance in their liquidity pool. And even though a lot of people were applauding them for that move, I think this should probably one of the last times they do this. I did have a very extensive discussion with one of the members of Horde, and so I made a video around the reasoning, the pros and cons of the move for the premium members. So there's a Bitcoin Strategy premium membership for currently $49 per month. Today's video is completely public. So every day there's premium content. Today's content is here free on YouTube. So hope you enjoyed the video. Let's jump right in. Welcome to another market update today on the 30th of April 2022. Let's talk about Horde again. Horde has made a move. They have moved 250,000 BUSD into the liquidity pool. And then there was a lot of hype around this, right? This was like a great announcement. People just comment, love it. But I don't think people actually really understand what's going on here. So I was pretty critical of that move. I'm not saying I'm criticizing everything all the time, but I simply don't think this is a good idea. And I will show you exactly why. What are the mechanics here? I don't think people really get this. So here's what happens, right? We've got a liquidity pool of two different tokens. So in our case, BUSD, right? So a stablecoin versus, in this case, the Horde token. And you put in your BUSD, you get out your Horde token, pushing up the price, right? Because there's now more BUSD in here than Horde tokens, so the price appreciates. Now we've got this trading range in Horde, right? Where we have an upper band and a lower band. The lower band now being $99, I think. The upper band being 111, if I'm not mistaken. We can look this up again, but it doesn't really matter for the argument. So we've got that trading range, right? And then the price here, it trades within the range. And then sometimes it might go very high, right? That's then when the liquidity manager injects a lot of new Horde tokens in here. It pushes down the price again, and it basically takes away this money that usually would have come into price appreciation. It goes into the liquidity manager to then, in the future, when people sell their Horde, right? When they get their reward from their nodes and the price declines, to then support the price. So in this case, then the liquidity manager would buy up the Horde token, pushing up the price, lowering the balance in the liquidity manager, right? So the liquidity manager, the balance of that wallet is a direct reflection of how stable, how great the project can run over the long term, right? The runway, so to speak. And you can measure that in US dollars or BUSD. You could measure this in how many cash outs are currently happening, how many claims are happening. You can measure this in daily allocated tokens to existing nodes. That's what I've done in my Horde video, which I think is also the most reliable measure of the three I've mentioned. But what has now the team done with this 250K thingy here? What actually has happened here? I've had a discussion afterwards about this. So what they've done is when the price here hits the upper band, right, the liquidity manager, so let's draw this over here, right, the balance of the liquidity manager over time, it goes up. Okay, so each time we hit here these upper bands, the liquidity manager goes up. And what they've now done is they have taken money. So this is now BUSDs, right? The BUSD goes up because they're selling the Horde tokens into the pool. What they've now done is they've taken away dollars from that liquidity manager wallet, and they've injected that money into the pool, right? So this money here, it went over here, okay? And they have done this in proportion to one another to not move the price. So they've both injected dollars and Horde tokens. The price didn't move at all, but the balance of the liquidity manager went down. What does this then do to the project? What happens is that the size of this liquidity pool is larger. Okay, so now there's not just $2 here and one Horde token here, but let's say $3 here and two Horde tokens over here. The ratio of the two is still the same after this injection. But what now happens is, because there's more money in the liquidity pool, whenever there is a buy order, for example, the price will move much less. So let me maybe draw this, I don't know, in blue, right? So in the future, the price movement will rather be like this. Okay, it will be much less pronounced. It will be less volatile. And that was the idea why they did this. So I will show you the exact chart afterwards. But that was the idea because we just recently hit this lower band here once in the price and people were freaking out in the Discord. They were saying like, oh my God, will this work? Can you do something about it? And of course the algorithm worked properly, right? The liquidity manager bought things up. In the chat, they even said that the liquidity manager didn't even have to intervene. I don't know if that's true, but still people freaked out. And so they said they wanted to reduce the volatility, that just a single sell order cannot really move this to the lower band. That's why they did the injection. But I personally think that's a bad idea because currently the Horde project is still very early and in a lot of growth phase. So when you look at the chart, you will actually see that in actuality, we see those upper bound hits much more often than the lower bound hits. Okay, so we just see rarely the lower bound being hit, but the upper bound is hit all the time, meaning that the liquidity manager, at least measured in BUSD, is going up. Not necessarily measured in token issuance of existing nodes, but that's another topic. Right now, there is more money going into the liquidity manager than out of the liquidity manager. Thus, what you want as a project, in my perspective, is you want this liquidity pool to be as small as possible to allow those high spikes, to allow filling this up. Now with this larger liquidity pool, we get way less spikes to the top over here. They are way less pronounced, meaning the liquidity manager might not be able to build the funds as quickly anymore, right? It might go up much less. And that's, in my opinion, a problem, right? You want the liquidity manager to grow quickly, especially when we are now still having so much node growth. You want that the payouts by the existing nodes, they are backed by the liquidity manager in the same proportion. You don't want the node count to double and the liquidity manager to only go up by 50%. It doesn't mean that the system has directly to crash, right? But it does mean that the stability, the runway of the project is declining. Thus, I think when we are currently in a growth phase, we should do the exact opposite. We should say, let's keep this small. Let's allow the liquidity manager to scoop up as many funds as possible, increase our runway, and thus increase the longevity, the stability, the durability of the project. And so I don't think many people got this. So the reactions here were very positive, blah, blah, blah. And then I came as the party pooper and sent my concerns here. And I will simply just read this to you. There is a bit of reading here, but I think it's important. So let's see how this plays out. So first of all, I was asking Will, who announced this, right? He seems to be communicating quite a bit here, and he's also answering very quickly. How are you measuring the runway? Because the reasoning here of this tweet was, here, let me first read the tweet, sorry. So the tweet was, 250k liquidity pair campaign complete. We decided to double the final injection of liquidity to bring the total up to 250k because the liquidity manager was so healthy. So this thingy here now has 250k. And that's the reason, right? Because the liquidity manager was so healthy. This was their statement. Thus, I was wondering, how are you measuring the liquidity manager? Because last time I looked, which was like 3 days ago, right? Which I presented in the last YouTube video, my measure of the liquidity manager of that thing over here in US dollars, of course, goes up, but measured in daily allocations to existing nodes is just stable. Okay, it's kind of like declining a little bit over the last weeks, but in the last 5 or 6 days, it was pretty much flat. Okay, so this is what I got from. I didn't think it was particularly healthy. It's really at how you look at this. How do you come to the conclusion that it's that healthy? I, at least, when I just see a flat line in the liquidity manager, not an increase measured in what I think is the most important measurement, as in daily allocations to existing nodes, I would have kept all the money in there, right? I wouldn't have done this move here, putting money from the liquidity manager to the liquidity pool. So that's what I asked. How are you measuring the runway? Are you measuring it in US dollars or in daily Horde allocations to existing nodes? That's what I do. Or in daily claims? Daily claims is a dangerous game, right? If you measure it in daily claims, not in daily Horde allocations, this might make sense at the very beginning. But when you rely on that metric, you're basically playing the Sphere or the Titano game, right? You will then come up to a long overhang of supply that's dormant in wallets, that's ready to be claimed and be thrown on the market. So you don't want to have that invisible supply overhang that can then crush the system directly. You actually want to look at how much did you allocate to people, not how much of that allocation that you gave to people are actually being claimed, because the claim dynamic can switch on a dime, right? When the momentum of the project turns around, then all the dormant supply will suddenly hit the market. And that's then what we see with Titano or Sphere. So really you should be seeing how much are you promising or how much are you allocating in Horde tokens to the people versus how much security in the liquidity manager do you have? That's my thought about this. So I was simply asking them that, right? Because this is a fundamental question, how you come to the conclusion that the liquidity manager is healthy or not. Or do you have maybe another metric? And so it would be interesting to know how you come to the conclusion that the liquidity manager is so healthy that it warrants moving some of the funds to the liquidity pool. Then the answer was, moving the funds to the liquidity pool makes the price more solid. That's what I just explained here, from big buys or sells. That's correct. That's why we are doing it, to keep it more stable for more volume. And the liquidity for the runway is the liquidity manager, treasury, and liquidity pool until the bottom pack combined. Now, I am not 100% sure about this, okay? So first of all, it's the runway is the liquidity manager, true. The runway is only the treasury if the team really in the end decides to use that treasury money to support the price. This is not yet baked in, it's not yet set into stone, right? And I don't know what happens, right? When times get really tough, currently times are not tough, but when times are tough and the momentum has turned around, is the team really going to throw good money after bad money? That's kind of like what that is, right? The momentum is bad. People are selling off. The liquidity manager loses balance. It's just going downhill. Are they going to throw that money, the treasury money that's not yet set in the liquidity pool or in the liquidity manager, would they really move that money over? It's not 100% certain. So I would at least, when considering the treasury money, I would at least put some kind of a discount on this. How high that discount is obviously depends on how much probability you give that case that the team will really decide to move that money over. My personal feeling is that the team is probably rather going to start something new, as in having a new branding, restarting maybe something similar, but probably try to turn around the momentum by having something that's related but not the same. Because if you just put the same money into the same at that point in time, right? We're all talking theoretically here, right? This is not the current state. But when the momentum for the project turns around, I'm not sure if it's really the wisest thing to do to simply take what's now the safe treasury money to put this into a liquidity manager. Now, I haven't mentioned the treasury here at all, right? But the treasury, it builds up when you create a node, right? When you've got 10 Horde tokens, 20% or $200 roughly, a bit more than that, goes to the treasury. That's simply just now building up and is being used for other investments. So it's unrelated money, so to speak. It's unrelated to the price action directly. And they're basically saying, okay, we would move that money to stabilizing the price. And that's the question there in the end. And he also says that the LP liquidity, right? Liquidity for the runway is the LM, the treasury, and the LP. I am not certain that that's the case. I don't think the liquidity pool is part of the runway. And that's because it's just the trading pair. It helps hitting the lower band less often, right? It stabilizes the price. But when this here, when the liquidity manager is at zero, then no money in the world of this liquidity pool is going to avoid the price falling below the lower pack. Okay? You can have a pool of $1 billion when your liquidity manager is zero. The liquidity manager cannot buy up the token. It's simple as that. I might be wrong in some things, right? But I think I do understand the mechanics somewhat correctly. If you've got any point here where I'm completely misunderstanding something, then please let me know, right? I want to learn here. This is not an exercise of bashing anything. This is simply an exercise of understanding really fundamentally the mechanics of what's going on and coming to the objective right conclusion, not to battle anything. That's why I'm trying to really discuss here with reasoning. Okay, so they're doing this to stabilize the price. They say the treasury and the liquidity pool is also the runway. I disagree with that, but I didn't argue on this. That's up to discussion, at least for the treasury. And then he answered, for my way of how to calculate the runway, he answered, it's quite hard to calculate accurately as you need to know the daily claims. Okay, so this would then say he's using this. The daily compounding, this would mean this, the daily buys and sells. So what he he's indicating here is that he really tends to look, or the team tends to want to look, even though they might not actually calculate this, because just say it's hard to accurately calculate. I don't know if they do this then or not. Maybe they really just look at the BUSD amount, who knows. But if they were to use a combination of these metrics, they would just again look at what are people actually doing, not what are they promising. And then this goes to the titanosphere kind of problem, right? You're just looking at what are actually people selling and not what kind of money have you allocated to people, what kind of tokens, then you've got a problem. And your allocation to existing nodes is not up for discussion, right? It's part of the whole system. You pay out your 0.1 Horde tokens a day to each node, and you know how many nodes you have. So you know how much you promise, so you know how much potential sell pressure there is in the very worst case. So the liquidity manager is used for the worst case, right? It's used for stabilizing the price when shit hits the fan. And so you have to work with the worst case. What's the worst case? Not what are people currently doing when momentum is still positive. So preparing for the worst case means measuring the worst case. Measuring the worst case means what are you currently allocating to existing node holders and using that in relationship to whatever BUSD balance you have over here. Okay, so let's move on. By the way, all this discussion here was in the Sleep Money Club by Andy. So if you've got more money spare, I think it's pretty good to get direct access to those people. They've got also other projects over here. So if you want to talk to directly the people of those projects, they seem to be active here. It's probably a pretty good way to get alpha, to understand project and the market a little bit better than the average market participant, if you're willing to take the time. And so let's move on. It's hard to calculate, so no real answer, I guess. But he indirectly answered this by adding all these other metrics here that are based on user behavior rather than on the algorithm itself. And that's a problem, right? You can't measure just what people are currently doing because you have to measure the worst case. And so I was asking, but do you really want the price not to be able to move a lot? As in, do you really prefer the blue line over here over the black line, right? Don't you want those big spikes here to fill up the liquidity manager? So if the liquidity pool is small, you would have more spikes that could fill the liquidity manager faster in positive times. And currently, you do hit the upper band more often than the lower band. After a large liquidity pool might move less money to the liquidity manager. And then he added here something else, and it's also treasury growth over time regarding hard to calculate for the runway, right? So that's probably the easiest. If you want to include the treasury growth over time, that's probably the easiest of the numbers to project because the node creation is pretty much linear right now, right? If you would take something like this as an approximation, you could come up with this. But of course, this is modeling. It depends how complex you want to do it. I like to keep it simple. I just like to look at what do people feel how rich they are, as in how many tokens could they claim from their nodes versus how much money is in the price stabilization. That's, I think, what matters. So the bigger the liquidity pool is, or different, the bigger liquidity pool will make the price less volatile. But doing it like that will make it harder to dump the price as well. It'll also make it harder to pump it as well. So exactly what I explained. So we agree here. Yes. And since you currently pump more than you dump, as in there's more green over here than red, you should want a small liquidity pool, as in you want more volatility to fill up the liquidity manager to increase the runway further, right? Since this happens here more, you want these big spikes. Thus, you want here not to have tons of money in here to push this thing here up and not to have a smaller slope over here. He then answered, we want the price to be more stable. Seeing it dip with relatively small sells makes people think it's being dumped a lot, while only a few thousand got sold. So yeah, this is the psychological argument as in, right? It only hit this once here and people were freaking out in the Discord channel. Oh my God, will this peg here stay? But my argument is, if you wait for long enough and you see that the price really trades in this range, and people will stop freaking out. They're simply freaking out because they don't understand. They don't understand how this thing here works. They didn't look at the blockchain, how in the past the liquidity manager did support the price. And so just when they see the price down here, they're already freaking out and think, oh my God, it could break, do something. And that's why, driven by this irrational emotion, the team did a move that probably is not sensible. It is sensible if all you want is slowing down irrational panic, but it's not sensible just based on the whole dynamics. But it's probably not in the interest of the team to be that hyper transparent around everything, because then people can very quickly anticipate when the liquidity manager doesn't grow quickly enough. So it's always a question, right? Is there conflict of interest? Yes or no? I don't want to say that they deliberately don't try to publish something. They do say they have a dashboard in the works to work on something like a dashboard, to work on something like the Runway, but I'm not sure if that will also show the real picture. They're probably just going to show the dollar amount of the LM and maybe the daily claims, something that's basically understating what's actually happening. So who knows? Let's wait for the dashboard and let's make our own calculations at the same time to try to come up with something that we think is more representative of the real situation. Then he continues, and this is good. But yes, I understand your point. Making the LP smaller will make it a lot more volatile and hitting those upper and lower ranges a lot more. There is a positive and a negative. And then my answer was, if you want the price really to be less volatile, to let people panic less, right? Because I think the swings are too hard. Why don't you just narrow the bands? As in, why don't you set this value over here to $105 and this maybe to $100, right? Just give them 5% of a trading range. That would 100% eliminate, by the way, the swing traders. Currently, it's only kind of eliminated because it's still more than 10% of a delta here, and you do have your 10% sell tax. So you could still swing trade this if you wanted to. So my argument was you might as well narrow the trading range if you want a more stable price. That would, by the way, also increase the liquidity manager faster in the current bullish times, right? If you lower this and make this closer, the price can only move in a narrower band, and then you will hit those upper bands more often. Currently, there is a demand overhang to a supply overhang, right? So having a narrow band will move this quicker into the liquidity manager. So that was my alternative solution if he doesn't like the swings. Instead of increasing the liquidity pool balance, why not narrow the band if that's what you're after? And then his answer was, narrowing the range will make the percent difference smaller. We don't want that. It will make it less attractive to buy at lower peg, as the percent difference will be lower. So that's interesting, right? They want to have some kind of a trading range to give people the idea that they get a good deal over here. And when there's not enough of a delta here, people wouldn't really feel that inclined to say buy another node or buy another plot, because it's not that much of a steal here. So maybe the motivation of people getting into the project is as well to get it cheaper than most people to buy at the lower peg. And so you want some kind of a trading range. That's his argument. That's why he doesn't want to get this narrower. Interesting thought. Haven't thought about this before. So that's exactly what I answered, actually. Interesting thought. I think you're overreacting with injecting liquidity because we hit the lower band once. Okay, so I came back to that. I think this is an overreaction to move the money over here because of this one hit of the lower band. The liquidity management algorithm works great, and it becomes more obvious as time goes on. I'd keep the liquidity pool small. The positive momentum builds up the runway, and maybe implement a smart buy feature to let people buy at specific levels. That way you could keep the pace of increasing the liquidity manager. Right now the liquidity manager will grow slower probably because the liquidity pool is larger. The spikes to the upside are smaller. So if instead you would keep the liquidity pool small, the pace of increasing the liquidity manager would stay the same, and the community could buy up low prices instantly without the liquidity manager being hit, right? If you had a smart buy feature, people could lock in a smart contract that they would like to buy that amount of tokens for that price. They could maybe deposit their BUSD, their 1000 BUSD or whatever it is, to buy 10 Horde tokens at $100. If they could lock this in before the price is at that level and we could make an automatic buy, then the liquidity manager wouldn't even been hit, right? So they would get this nice deal. They would buy lowly, but the liquidity manager doesn't have to stabilize the price anymore. That would be great, right? We would only have inflows into the liquidity manager, at least when the number of buy orders here is high enough. And the people that just come new to the project that don't know about this feature, right, they might still buy up at higher prices. So for all the influencer buyers, right, when there's a lot of promotion, this would probably still happen that the upper band is being hit. So that way you could keep the pace of increasing the liquidity manager and the community will buy up lower prices instantly without the LM being hit. I don't think it's a good idea to do a decision against the runway, right? This is what that is, because I don't see the liquidity pool as part of the runway. It does not stabilize the price. So this is a direct decision against the runway, in my opinion, for the psychological reason of stabilizing the price, because the price is stabilized anyway, right? People just need to know over time. Then I added, people will freak out less over time as they see the algorithm works. His answer is, yes, that's true, positive and negative, but I think the liquidity pool will be untouched now, at least for now, as we had the liquidity pool growth campaign ending today. We thought about raising it just a bit more, as we won't be doing this very often. So there was probably another reason, not just the dip here. There was this liquidity growth campaign, a marketing campaign saying our liquidity pool will grow. That's in the end why they also did it, probably. And let's hope that they won't get too excited about doing this again. I don't think they will reduce liquidity now from the liquidity pool. That's very unlikely. That would be a pretty bad look on the project. But I at least hope they will stop doing this in the future, even though they might package this nice in a tweet and people might give them hearts and stuff. But really, you want long-term sustainability. People will really give you hearts when your project is alive for 300 days and continues to grow when the first nodes, the first plots decay. That should really be the main focus. Your focus should be the runway. Thus, I think you should really think hard about how to measure this. How do you really want to measure this? Maybe you already have something really fancy that's simply not just shown in a dashboard and you are already thinking about this, but that's not the case. If it's still a side thought and you're just looking at the BUSD amount, then I think that should change. Okay, so that was my discussion with Horde. Quite a lot of talk around this. I do want to come to a few more things. So let's talk about the general market, because the technology stocks, they are really pushing us down, right? So since beginning of the year in the NASDAQ, we went down by 22%. Amazon got completely crushed. And this also, of course, has impact on crypto. So when we look at Bitcoin with the best moving averages, we could not cross what was a support line for quite a while. This is now a resistance that had unfortunately not been broken. We are below the best exponential and simple moving averages. Now the big question is, can we hold the secondary support that we have hit several times? And I think it probably has a lot to do with what technology stocks in the end will do. So the correlation between Bitcoin and US tech stocks continues to be high. Ethereum also doesn't look that great, right? Our support here is approximately 10%, additional loss of 10% from here. Bitcoin versus Ethereum might be breaking its sidewards trading range. So potentially this will not happen. If we really go down here, then Bitcoin, of course, will increase versus Ethereum, right? If technology stocks continue to lose, then Bitcoin is a safer bet. Thus, Bitcoin would win against Ethereum. Bitcoin dominance stays at 42% roughly. Not a lot of movement here. Total 3 minus stablecoins is pretty close to a low. So a quite strong support here, actually. So what we might see is, in case we don't go completely south from here, we might see the rebound in altcoins faster than we see this in Ethereum, because the support is simply way closer here than it is over here. So if we do go bullish, which I don't think is the likeliest scenario, but in case that happened, then the altcoins are probably going to outperform Bitcoin and Ethereum quite a lot. And the second reason for that is also that the stablecoin dominance is now very close to an all-time high. So let's look at this, right? We did have intraday movements that were slightly higher, but when we look at the day closes, right, very, very close to the all-time high, meaning a lot of money is on the sidelines, ready to be deployed when momentum turns bullish again. So there is this inverse correlation, right? A top here in the stablecoin dominance is a bottom here in Ethereum, and a top here in Ethereum is a bottom in the stablecoin dominance. So basically inverse correlation. Now we are very high, meaning this could be a bottom for Ethereum or now for altcoins mainly, right? The main trading happens between stablecoins and altcoins. So a lot of money in stablecoins means a lot of potential dry powder that could be deployed in altcoins that would then rally. But currently things don't look like a rally, right? Let's look at this. This is all pretty red, very ugly. Especially Phantom is getting beaten up a lot. Let's look at the top 100 in the last 24 hours. There are still winners, but they are not massive. There is one very small coin, right? It just moved probably in the top 100, XDC. I don't know the background around this pump. There are losses, especially profit taking, right? The main loser is ApeCoin that went really, really well in the last days. But Phantom is kind of like the surprise loser. Why is Phantom the second most losing coin in the top 100? I don't have the explanation for this. What I do find interesting, so this is Phantom versus US dollars. What I find interesting is the support here has broken. But what's even more interesting is actually the relative valuation of Phantom. This is already the relative valuation. Okay, so this is the US dollar valuation. Support has broken. Relative valuation of Ethereum also has broken. If we now try to find some kind of a support, we can just try to see how much we lost in the past during those kinds of movements, right? These are pretty similar movements. So when we just overlay this, but this is obviously no science here, right? We already made a pretty bad comparison over here. If we just overlay this, then we might be seeing a support somewhere around here. That's another drop versus Ethereum of 33%. Who knows? The general sentiment continues to be bearish, as seen with the historically best moving averages. If you are getting into anything right now, then Phantom does look cheap, but it doesn't seem like it has any supports. There is a lot of money in stablecoins, all right? That's the point. It's not the worst timing in the world to get into risk on when stablecoin dominance is that high, historically speaking. These were exceptional opportunities. So according to your risk tolerance, feel free to get in. If you are a bit more risk averse, then maybe wait until we hit some kind of a turnaround again with the best moving averages here in total 3. So that's my thought on the overall market. Thanks again for watching. See you in the premium chat or see you in the next video. Bye bye.